All right, let's dive straight into this explainer and demystify exactly how you can put your cash to work and, actually start investing today. I know, the financial world can sound like a completely foreign language when you're just starting out. It's just full of these weird acronyms and endless jargon that make the whole process feel, well, incredibly intimidating. But today, we're stripping all of that away. We're going to look directly at the absolute foundational concepts that'll take you from sitting on the sidelines to confidently building real long-term wealth. So, we're going to break down this intimidating world into 5 clear steps. 1. Why you must invest. 2. What to actually buy. 3. The secret to market timing. 4. Understanding your risk profile. And 5. How to execute a trade.
Section 1. Why you must invest to beat inflation. Let's start with the most foundational question here. Why even take the risk to invest in the first place?
Well, it's incredibly common to feel safe just leaving your extra money sitting in a standard checking account, right? But what's actually happening to that cash? The harsh reality is, if you just leave it there, it's actively losing value every single day. Why? Because the U.S. Federal Reserve deliberately targets a 2 to 3% inflation rate every year just to keep the broader economy humming. So you might not literally see your bank balance go down on your screen, but your purchasing power? Yeah, it's absolutely bleeding out over time. And this brilliantly illustrates the hidden, everyday cost of that inflation using something we all understand, the price of a Chipotle burrito. Think about it. Just a few years ago, back in 2019, a burrito cost, about $8.50. Today, it's closer to $12. Meaning, if you had $50,000 in cash back in 2019, you could have bought nearly 5,900 burritos. That's a lot of burritos. But today, that exact same 50 grand buys you just over 4,100. That means you can afford 1,700 fewer burritos today with the exact same amount of money. You are literally affording less of the world simply by holding on to cash. So, the absolute crucial point here is that to beat inflation, we must invest. We have to outpace that 2 to 3% bleed. And historically, the broad stock market gives us a very reliable 8 to 10% average annual return. And that's looking at the past 80 years. Now, sure, there are dips, valleys, flat periods, but the general trajectory over a long time horizon is steadily upward, keeping you comfortably ahead of inflation. Just look at how this builds over time using the absolute magic of compound interest. You know the old saying, right? It takes money to make money. If you stash $1,000 under your mattress for 20 years, well, it remains exactly $1,000 and buys way fewer burritos. But if you invest that same $1,000 and earn a 10% return, year 1 yields $1,100. In year 2, you earn 10% not on the original $1,000, but on the $1,100. By year 20, that simple $1,000 left alone becomes a massive $6,727. Your money is essentially working an invisible shift, just making its own money for you. Section 2. What to buy, stocks and ETFs. So now that we know why we need leverage, let's figure out exactly what vehicles we should actually park our money into.
Now, you could buy art, Pokemon cards, or gold, but stocks, which, by the way, are just shares of ownership in public companies, are vastly superior for beginners. Why is that? Because unlike real estate, where selling a house takes 30 days of listing, finding a buyer, and closing, stocks are extremely liquid. This means you can literally buy a share of a company in the morning and easily cash it out by the afternoon. Plus, they're accessible to anyone with an internet connection and offer really predictable long-term returns.
Okay, so when you actually want to buy a stock, you need to know its ticker symbol. The best way to think about a ticker symbol is exactly like a 3-letter airport code. If you want to fly to New York, you use JFK. If you want to route your money to Apple, you use AAPL. Tesla is TSLA. It's really just the destination code for your cash. But here's the thing. Picking individual stocks can be deeply risky. I mean, if you had invested your life savings into one single company like Intel back in the year 2000, you literally still wouldn't have recouped your money today. No way. That is exactly why financial professionals strongly recommend index funds and ETFs, or exchange-traded funds. Instead of making risky bets on a single company, an index fund is basically a giant basket of stocks that automatically tracks a huge market index. And because there's no high-paid Wall Street manager actively picking those stocks, the fees are incredibly low, and you get instant automatic diversification. For instance, let's look at an S&P 500 ETF, which tracks the 500 top companies in the US. A super popular ticker symbol for this is VOO. By buying just one single share of VOO, your cash is instantly split across Microsoft, Apple, Nvidia, Tesla, and 496 other massive companies. You don't have to stress about picking the single winner. You basically just buy the entire American economy and let it ride.
Section 3. Market timing and when to invest. Now, the biggest psychological barrier for beginners is the paralyzing fear of buying at an all-time high. So let's tackle that head on. People love to wait on the sidelines for a dip, right? But what if I told you the S&P 500 actually spends about 21 trading days a year at all-time highs? And surprisingly, new highs are usually followed by more new highs. The data from the last 30 years is honestly shocking. If you try to time the market and miss just the 10 best trading days, you erase over half, literally 54% of your potential gains. Miss the 30 best days, and you lose 83% of your returns. So the golden rule? Time in the market almost always beats trying to time the market. This quote right here from financial writer Nick Migulali perfectly captures the shift from a trader's anxious mindset to an investor's calm strategy. He says, rather than worry about whether now is the right time to buy, just keep buying. Market high or market low, just keep buying. Now, it's true that if you buy a stock when it's temporarily expensive, your short-term returns might lag a bit. But over a 20 to 30-year horizon, initial market valuations matter very, very little. Think about it. In 2012, everyone was Googling how the stock market was 50% overvalued at 1,400 points. If you listened to that fear, you would have totally missed out as the market climbed to more than 4 times that value over the next decade. So seriously, just keep buying. To completely remove the emotional stress of market timing, there's a brilliant strategy called dollar cost averaging. Instead of dumping, say, 12 grand into the market all at once and just praying it doesn't crash tomorrow, you automate your investments. You set up a system to invest $1,000 on the exact same day every single month. When the market is expensive, your fixed $1,000 naturally buys fewer shares. But when the market crashes and goes on sale, that same $1,000 automatically scoops up more shares. It's fantastic because it completely takes the emotion out of the equation. Section 4. Your risk profile and knowing your goals. Because before you hit that buy button, you absolutely must align your strategy with your own personal timeline. The reality is a 20-year-old and a 60-year-old just shouldn't have the exact same portfolio. If you're young, you have the ultimate leverage. Decades of time. If a financial crisis tanks your portfolio by 30%, well, you have 20 or 30 years to recover. So you can afford to be heavily invested in aggressive growth stocks. But if you're 60 and retiring in 5 years, your priority naturally shifts. You don't have the time to wait out a decade-long recovery, so your strategy really must transition toward preserving the capital you've already built. Having that self-awareness of your timeline is absolutely key. Section 5. How to trade and making the buy. We know why we invest, what to buy, and the mindset to hold. Now let's dive into the actual logistics of taking your cash and buying a slice of the stock market. First things first, you're going to need an account. And thankfully, gone are the days of calling up some chaotic stockbroker on a landline. Today, you just open an account online with a platform like Fidelity, Schwab, or Robinhood. You basically have 2 main buckets to choose from here. A retirement account, like a 401k or IRA, gives you amazing tax perks, but it does legally lock your money up until retirement age. Or you can go with a standard brokerage account. This offers no special tax breaks, but it gives you complete flexibility to withdraw your cash literally whenever you want. Once your account is approved and funded from your checking account, the process is universally simple across pretty much every modern app. You just use the search bar to find your ETF's airport code, let's say VOO. Then you enter either the dollar amount you want to spend or the number of shares you want to buy, select your order type, review the estimated cost, and boom, swipe or click to submit. Now, when you go to submit, these platforms will let you choose your order type. The 2 most common ones are market orders and limit orders. A market order is kind of like walking into a store and paying whatever the price tag says right now. It executes instantly at the current trading price. A limit order, on the other hand, gives you ultimate control. Say a stock is trading at $610, but you refuse to pay a penny over $600. You just set a limit order for $600. The app will patiently wait, and the trade will only execute if and when the price actually drops to your dictated level. Understanding how to invest your money is absolutely the ultimate tool for financial freedom. As we've seen throughout this explainer, the true cost of doing nothing is basically guaranteeing that your cash loses its purchasing power year after year. The market doesn't require you to be some genius stock picker, It just requires you to be consistent, automated, and patient.
So take a look at your checking account right now and ask yourself, what will your future self wish you started doing today? Seriously, don't wait for the perfect moment. Pick an index fund, set up your recurring investment, and start building your own compounding machine today.